Thanks a lot. In Money Tuesday, Wall Street starts the year bullish about stocks. So what does that mean for your investments? Well, financial planner Stewart Welch joins us as he does every Tuesday. It's always good to see you.
Good morning.
Thanks so much for being with us today. Okay, I mentioned bullish. A lot of folks very upbeat about this upcoming stock year.
Yeah, I think the stars have finally lined up, so it looks like it is going to be a good year from the stock market.
You know, some people saying, I mean, as it was last year, 2010 was a strong year.
It was.
So after looking at 2010, see where everybody went, what do people need to keep in mind with their investment dollars for 2011?
Well, I think the first thing is to stop and review where you are, and if you believe as we do that the stocks are going to do well, you might want to realign your portfolio so that it is more oriented towards stocks. A lot of people had shifted away from stocks during 2008 in particular, and a lot of people have left their portfolios alone. Don't wait until the market's made a big move before you begin to put money back into the stock market. Okay,
let's talk a little bit about when it comes to stocks. In particular, you're talking with retirees. If you're trying to develop a little cash flow, you recommend consider some of the blue chip dividend paying stocks.
I do. I think if you're a conservative investor, or particularly if you're a retiree, the blue chip stocks, a couple of names are AT&T, Southern Company, McDonald's, Kimberly-Clark. These are the kinds of companies that are paying really strong dividends. They have really strong balance sheets. They have a history of raising their dividends.
Instead of trying to pick all of that too, you say there are a couple of options out there where you either look for like a mutual fund or an ETF, an exchange traded fund, right?
You could. You can pick up a basket of these dividend stocks. One of them's an exchange traded fund, and the symbol is DVY. It's part of the iShares group. You can go to iShares.com and get more information.
Okay, let's talk a little bit about, you say small cap stocks are going to also be an area. They did fairly well. Small cap stocks performed well in 2010 as well.
They have actually done very well. They have actually recovered most of what they've lost. So you know, there's some people looking at those and saying, "Wow, it's hard to believe they're going to continue to make another move up." But if the economy continues to improve, they're real nimble, and we think that they will do very well as well.
Okay, let's talk about emerging markets. You say that's an area where people have been really big on those areas, but on these emerging markets, international funds, but particularly this year.
Emerging markets, a lot of those emerging market countries missed the big disaster around the financials, what happened in the financial markets, and they're really poised and actually already starting to move in terms of making a big move this year. So you can use a mutual fund. Vanguard Emerging Markets is a good mutual fund, low cost, no load fund. That would be an excellent choice.
Okay, the one place where people have been talking about potential problems in this new year, bonds.
Bonds are, I think that there was a big bull market in bonds. I think that's pretty well over. The bonds are the area that is the least likely to do well. The strategy, in my mind, would be to shorten your maturity. Look at what you have in bonds. Don't stay with a longer maturity. Shorten your maturity. I liked Vanguard short-term investment grade, has an average maturity of a little less than 3 years. It's paying a little over 3%. You're not getting paid a ton of money, but it's a very cautious strategy there.
Stocks and bonds this week. Next week, you're going to talk to us about real estate and commodities, gold, all of those things.
We'll finish it up.
It's good to see you as always. Thanks so much.
Thanks, Rick.